Have you ever heard people talking about 10x or 20x leverage, going long or short, and you're not exactly sure what's happening to your money? If that sounds familiar, this video is for you. Many traders, even those who know Bitcoin and Ethereum, get confused by spot, futures, and leverage. Understanding the difference is critical to managing your risk and avoiding costly mistakes. By the end of this video, you'll have a clear, simple framework for all three. Welcome to CryEdge. We do no hype, just structure, risk, and process. Let's start with the foundation, spot trading. Simply put, when you trade on the spot market, you are buying and owning the actual cryptocurrency. If you buy one Bitcoin, you own one Bitcoin. It's yours. Your maximum risk is the capital you invest. If you put in $1,000, the most you can lose is $1,000. Let's use a clear example. Imagine you buy $1,000 worth of BTC on the spot market. If the price of Bitcoin goes up by 10%, your position is now worth $100. You've made a $100 profit. If the price drops by 10%, your position is worth $900. If it drops by 50%, it's worth $500. The asset is still yours, and you can hold it, hoping the price recovers. The pros of spot are its simplicity and lower risk. There's no liquidation, which means the exchange won't automatically close your position. This makes it great for beginners and long-term investors. The main limitation is that you can't use leverage, so you need more capital to see large percentage gains. Now, let's move on to futures. A futures contract is a derivative. That means you aren't buying the coin itself, but a contract that tracks its price. For example, the BTC USDT perpetual contract on an exchange like Bybit follows the price of Bitcoin. The first key difference from spot is that you don't own the underlying asset. The second is that futures allow you to profit from price movements in either direction. You can open a long position, betting the price will go up, or a short position, betting the price will go down. This also introduces new elements, like funding fees and, most importantly, liquidation risk. Let's imagine you open a $1,000 long position in BTC futures with no leverage, which is 1x. This works just like spot. If the price goes up 5%, your profit is $50. If it goes down 5%, your loss is $50. But because you're trading a contract, the mechanics are different, which brings us to the most powerful and dangerous tool, leverage. A quick warning: futures are not for absolute beginners. You must have a clear risk management plan before you even consider them. This is where most traders get into trouble. Leverage lets you control a larger position with a smaller amount of capital, known as margin. It amplifies everything, your potential profits, and crucially, your potential losses. Let's break it down with numbers. Imagine you have $1,000 of capital. In case A, you use no leverage, or 1x. Your position size is $1,000. If the price moves up 10%, you make $100. If it moves down 10%, you lose $100. Simple. Now, case B, 5x leverage. With your $1,000 margin, you now control a $5,000 position. If the price moves up 10%, that 10% is calculated on your $5,000 position. Your profit is roughly $500, a 50% gain on your initial capital. But if the price moves against you by 10%, your loss is roughly $500. Half your capital is gone in one trade. Finally, case C, 10x leverage. Your $1,000 margin now controls a $10,000 position. If the price moves against you by just 10%, you lose $1,000. Your entire margin is wiped out. This is called liquidation. The exchange automatically closes your position to prevent further losses. The psychological pressure of watching this happen is immense and often underestimated. Here are our rules at CryEdge. Never use high leverage for excitement. Only use leverage if you have a clear stop loss and know your invalidation level, the point at which your trade idea is proven wrong. If you don't have that, you shouldn't be trading with leverage. So how do rational traders combine these tools? A common strategy is to use spot for long-term accumulation. Think dollar cost averaging into Bitcoin or Ethereum. This is your core portfolio. Then, they might use low leverage futures, maybe 1x to 3x, for two main purposes: short-term trades or hedging. For example, if you hold a large spot BTC position but anticipate a short-term pullback, you could open a small short futures position to hedge or protect your portfolio from that drop. Another example is a structured trade. You identify a clear chart pattern with a predefined entry, a defined invalidation level where you'll place your stop loss, and you use moderate leverage, risking only 1 to 2% of your total capital. The goal isn't to hit one huge win. The goal is to survive long enough to build skill and a repeatable process. Let's do a quick recap. 1. Spot trading is when you buy and own the asset. Your risk is limited to your capital. 2. Futures are contracts that let you go long or short, but they come with extra fees and liquidation risk. And 3. Leverage is a multiplier. It makes everything faster and much more dangerous if you aren't disciplined. You don't need luck in trading. You need a method and a deep respect for risk. If you want to practice what you've learned today in a responsible way, you'll find my Bybit affiliate link in the description. Using it to open your account or log into your existing one is the best way to support CryEdge at no extra cost to you, and it helps me keep creating structured, no-hype educational content like this. If you found this helpful, please subscribe and like the video. And if you have any questions about spot, futures, or leverage, ask them in the comments below. I'll use them for future videos.